The red candles are back. Bitcoin, which seemed unstoppable just this summer, is showing serious signs of weakness. The market is bleeding, and it's not a slow bleed, it's a hemorrhage. In the last several days, we've seen a significant painful drop. After hitting a peak of around $124,500 in mid-August, Bitcoin has stumbled, recently falling below the critical $100,000 psychological level. That's a brutal 20% correction from its recent all-time high. Across the board, the total crypto market capitalization has seen hundreds of billions of dollars erased. Just this week, we witnessed one of the largest liquidation events of the entire year. It was a brutal cascade that wiped out over $1.1 billion in leveraged positions in a single 24-hour period, with the vast majority of those being hopeful bets on prices going up. Over 246,000 traders were liquidated in that event alone. Their positions, their hopes, their capital gone in a flash. I know what you're thinking. Is this just another Tuesday in crypto? Another volatile swing we should just brush off? I'm here to tell you this feels different. This isn't just random volatility. This is a direct response to a perfect storm of macroeconomic pressures that have finally arrived. A toxic cocktail of hawkish central bank policy and classic recession warnings is causing a massive, violent sell-off in the crypto market. In the next few minutes, I'm going to show you exactly why these macro events are the trigger for the market-wide collapse that many have been warning about. More importantly, I'm going to lay out a clear, actionable plan for what you can do right now to protect your portfolio. This isn't about panic. This is about preparation, because the ones who survive and thrive in a bear market are the ones who see it coming and act before it's too late. All right, let's break down what is happening piece by piece. You need to understand the mechanics of this crash to appreciate the danger we're in. This isn't just about a few negative headlines. We are at the convergence of several massive bearish forces, creating a perfect storm for risk assets, and crypto is at the top of that list. First, let's talk about the Federal Reserve. For months, the market has been running on the hope, the expectation of steady interest rate cuts. Rate cuts mean cheaper money, which encourages investment in risk assets. However, the Fed's recent tone has shifted. After a quarter-point rate cut in October brought the benchmark rate to a range of 3.75% to 4%, the odds of another cut in December have plummeted. Just weeks ago, the market was certain of a December cut. Now it's a coin toss, with some markets reflecting a less than 50% chance. Why does this matter so much? Because higher interest rates, or even the fear of rates staying higher for longer, act like gravity on assets like crypto. It makes holding cash or bonds more attractive and drains liquidity from speculative markets. The moment the Fed signaled a more restrictive stance, we saw a synchronized outflow from both traditional finance and crypto. This isn't a crypto-specific problem. It's a global liquidity problem, and crypto is one of the biggest victims. Adding to the tension is the delicate situation with global trade. While a full-blown trade war has been averted for now, with a recent US-China agreement to de-escalate, the markets remain on edge. This truce, which involves adjustments to tariffs and export controls, is seen by many as fragile. This underlying uncertainty means investors are still fleeing from risk. They pull money out of speculative assets like tech stocks and cryptocurrency, running for the perceived safety of government bonds. This is called a flight to safety, and we are seeing a massive one happening right now. This directly impacts crypto because in the eyes of institutional money, Bitcoin is still a high-risk asset. When they get scared, they sell first and ask questions later. Now, let's add the third horseman of this macro apocalypse, the inverted yield curve. I know this sounds like a complex financial term, but it's brutally simple and one of the most reliable recession indicators in history. An inverted yield curve is when the interest rates on short-term government bonds are higher than the rates on long-term bonds. This is unnatural. It signals that investors are so worried about the near-term future of the economy that they are demanding higher pay to hold short-term debt. For the better part of the last year, the yield curve has been inverted, flashing a massive warning sign for a recession. Every single US recession in the past 50 years was preceded by an inverted yield curve, while parts of the curve have recently started to uninvert. This has been driven by the Fed's rate cuts and a narrative of slowing growth, not a sign of a healthy economy. The bond market is screaming that an economic slowdown is coming. When a recession hits, risk appetite evaporates. Institutional investors de-risk their portfolios, and the first thing to be sold off is often their most volatile holdings, which includes Bitcoin and the entire crypto asset class. So, what does this all mean when you put it together? It means the psychological foundation of the market is cracking. We can see this with 100% clarity in the crypto fear and greed index. This index measures market sentiment. A high number means greed, a low number means fear. Right now, the index has plummeted into extreme fear, hitting a score as low as 10 out of 100 and staying in that deeply fearful range for a week. This isn't just a number on a chart, this is a reflection of real panic. This is what it looks like when investors, both retail and institutional, are capitulating. They are selling at a loss just to get out. The market is gripped by a profound sense of dread, and the macroeconomic environment is validating that fear every single day. The problem is here. It's not looming, it's happening right now, and the worst may be yet to come. So, we've established the storm outside, the Fed, the recession signals, the global uncertainty. But what makes this situation truly catastrophic for crypto is the storm inside. The internal structure of the crypto market is a house of cards built on a foundation of unprecedented leverage and systemic risk. This is why a 5% drop in the stock market can translate into a 20% or 30% collapse in crypto. And this is the part of the story that the mainstream media completely misses. Let's start with the single most dangerous element in crypto: leverage. In simple terms, leverage is borrowed money. Traders use it to amplify their bets. If you have $1,000, you can use 10 times leverage to control a $10,000 position. If the price goes up 10%, you don't make $100, you make $1,000. It sounds amazing when you're winning, but if the price goes down just 10%, your initial $1,000 is completely wiped out. This is called liquidation. Now, imagine this happening to hundreds of thousands of traders at the same time. This is what we call a liquidation cascade. When prices dip, the most highly leveraged long positions are automatically liquidated by the exchanges. This forced selling creates more downward pressure on the price. That new lower price then triggers the next wave of liquidations for traders with slightly less leverage. This creates a domino effect, a death spiral of forced selling that feeds on itself, turning a small dip into a catastrophic crash. This is exactly what we've seen in the past few days. The recent $1.1 billion liquidation event saw over $968 million of that coming from long positions. People betting the price would go up more than 250,000 accounts gone. This mechanism doesn't really exist in the traditional stock market in the same way. The stock market has circuit breakers, automatic trading halts that are triggered during a massive crash to give the market a chance to breathe and prevent panic. Crypto has no circuit breakers. It's a 24/7, fully automated, brutally efficient liquidation machine. There are no brakes on this train. This brings us to the second layer of fragility: the exchanges themselves. During these periods of extreme volatility, the very platforms you trade on become a point of failure. We've seen it time and time again. When the market is crashing and everyone rushes for the exits at once, exchanges can freeze, withdrawals can be halted, trading becomes impossible. You can see your portfolio evaporating in real time, but you are completely powerless to do anything about it. Remember FTX, remember Celsius, remember BlockFi? These were not just isolated incidents of fraud. They were demonstrations of a core systemic risk in crypto: counterparty risk. When you keep your crypto on a centralized exchange, you don't actually own your coins. The exchange owns them. You own an IOU from the exchange. If that exchange becomes insolvent, as FTX did, your funds are gone forever. And in a market-wide crash, the pressure on all of these exchanges becomes immense. Liquidity dries up, and the risk of a run-on-the-bank scenario spreads like wildfire. This fear isn't just theoretical. It's showing up in the data. Look at the outflows from Bitcoin ETFs. These are the regulated institutional-grade products that were supposed to bring stability. Yet on November 13th, spot Bitcoin ETFs saw net withdrawals of nearly $870 million, the second largest outflow on record. When the institutional smart money is pulling out at this rate, it signals a profound loss of confidence. They are de-risking, and they are doing it fast. This is the exact opposite of the steady institutional adoption narrative that fueled the bull market. The hot money that rushed in is now rushing out just as quickly, leaving retail investors holding the bag. The contagion doesn't stop there. It spreads to the very heart of decentralized finance, or DeFi. Recent crashes saw massive liquidations not just on centralized exchanges, but across DeFi lending platforms Ethereum and other altcoins, which are often used as collateral for DeFi loans, suffered devastating losses. The system is so interconnected that a failure in one corner can trigger a collapse across the entire ecosystem. And let's talk about stablecoins. These are supposed to be the safe harbor within crypto, tokens pegged 1 to 1 with the US dollar. But what happens if a major stablecoin depegs? What if the company behind it doesn't actually have the reserves to back every token? We saw a preview of this with Terra Luna, where a flawed algorithmic stablecoin design led to a $40 billion ecosystem collapse and triggered a chain reaction of insolvencies across the industry. In a true market panic, a run on a major asset-backed stablecoin is a black swan event that could instantly freeze the liquidity of the entire market. Trading would grind to a halt because the very asset used to price everything else would no longer be trusted. This is the agitation. It's not just that the price is going down, it's that the underlying structure of the market is built to accelerate that downward spiral. We have a system with no circuit breakers, supercharged by leverage, haunted by the ghosts of past exchange collapses, and now facing a massive withdrawal of institutional confidence. This is the house of cards, and the macroeconomic winds are blowing harder than ever. Look, I know this is a lot to take in, and it's frankly terrifying, especially if you have a significant portion of your net worth in this market. The feeling of powerlessness as you watch your portfolio drop is one of the worst experiences an investor can have. You feel trapped. You see the exchange might be lagging, you hear the stories of frozen withdrawals, and you start to wonder, are my assets even safe? This is precisely why, for years on this channel, I have been talking about one of the most critical concepts in all of crypto, self-custody. This is not the time to be trusting a third party with your digital assets. The risk of an exchange failure is not zero, and in a full-blown bear market, that risk increases exponentially. The solution is not to panic sell. The solution is to take control. This is where a hardware wallet comes in. A hardware wallet is a small physical device that stores your private keys offline. This means that even if an exchange gets hacked, goes bankrupt, or freezes your account, your crypto is completely safe and under your control. It cannot be touched. I personally use a ledger to secure the majority of my long-term holdings, and it's the single best thing you can do to sleep at night during a market crash. If you don't have one yet, I strongly urge you to consider it. It is the fundamental first step in protecting yourself from the systemic risks we just discussed. This isn't just about surviving the bear market, it's about ensuring you're still in the game when the next bull market begins. Okay, we've diagnosed the problem and we've agitated the consequences. Now we move to the most important part, the solution. Panic is not a strategy. Hope is not a strategy. A clear, disciplined, and unemotional plan is the only thing that will get you through what's coming. A bear market isn't just a time of loss. It's a time of immense opportunity, but only for those who are prepared. I'm going to lay out a 4-part survival blueprint. This is your guide to navigating the chaos. Part 1, secure your foundation. The primacy of self-custody. We just touched on this, but it needs to be the absolute first step you take. Before you make a single trade, before you decide to buy the dip or sell the rally, you must secure your assets. I cannot overstate this. Get your coins off the exchanges. The counterparty risk we discussed is not a joke. During the FTX collapse, people who thought they were multimillionaires discovered they owned absolutely nothing overnight. Their assets were commingled, lent out, and gambled away, and they had no recourse. By holding your crypto on a centralized exchange, you are accepting that same risk. A hardware wallet, like a ledger or a Trezor, is your personal vault. When you set it up, it generates a set of private keys that are stored securely on the device itself. These keys never touch the internet. To send a transaction, you must physically connect the device and approve it. This makes it virtually impossible for a remote hacker to steal your funds. More importantly, it makes you immune to exchange failure. If Coinbase, Binance, or any other exchange goes down, it will be a non-event for you because your crypto isn't on their balance sheet, it's in your possession. Setting one up is simple. You buy the device, follow the instructions to generate your 24-word recovery phrase. This is the single most important piece of information, as it can restore your wallet if the device is lost or broken, and then you transfer your crypto from the exchange to the new addresses provided by your hardware wallet. Write down your recovery phrase on paper or stamp it into metal and store it in multiple secure offline locations. Never store it as a digital file on your computer or phone. This is your master key. Protect it as such. This step is non-negotiable. It is the bedrock of your entire crypto strategy. Part 2, develop your thesis. Become a trend follower, not a bull or a bear. The single biggest mistake I see people make in a bear market is getting emotionally attached to a bias. They become a perma-bull, convinced that every drop is the absolute bottom and a V-shaped recovery is just around the corner. Or they become a perma-bear, convinced the price is going to zero and they miss incredible buying opportunities. My philosophy is simple. I am not a bull or a bear. I am a trend follower. My job is to identify the direction of the primary trend and position myself accordingly. Right now, the trend is unequivocally down. Acknowledging this reality is not pessimism, it's realism. It allows you to make clear-headed decisions. So how do you develop your own thesis and track the trend? You need to watch a few key indicators. First, the macro environment we discussed. Pay attention to the Federal Reserve. Are they talking about more rate cuts or are they holding firm? Watch inflation data like the CPI, Consumer Price Index. High inflation could force the Fed to remain restrictive, which is bad for crypto. Second, watch the key technical levels on the Bitcoin chart. Identify major support and resistance zones. Right now, Bitcoin has lost support at the $100,000 level. If it continues to break down, the next major support zone could be significantly lower, with some analysts pointing towards the $93,000 to $94,000 region. Conversely, watch for key resistance levels on any bounces. Is the price getting rejected at former support levels? This is a classic sign of a downtrend. Third, look at market sentiment. Keep an eye on the fear and greed index. While extreme fear can sometimes mark a market bottom, a prolonged period of extreme fear is characteristic of a brutal bear market. Don't try to be a hero and buy just because the index is low. Wait for a sustained shift in sentiment, confirmed by price action. By focusing on these data points instead of your emotions, you move from being a gambler to being a strategist. You are no longer just hoping. You are observing and reacting to what the market is telling you. Part 3, actionable strategies, how to play defense and offense. With your assets secure and your thesis in place, you can now implement specific strategies. First, dollar cost averaging, DCA. For your long-term holdings, DCA is your best friend in a bear market. This means investing a fixed amount of money at regular intervals, regardless of the price. For example, you might decide to buy $100 worth of Bitcoin every single week. When the price is high, your $100 buys less Bitcoin. When the price is low, your $100 buys more. Over time, this strategy averages out your entry price and removes the emotion, and the impossible task of trying to time the exact bottom A bear market is a gift to a DCA investor, allowing you to accumulate a larger position at a heavily discounted price. Second, resist the urge to catch a falling knife. This is the opposite of DCA. This is when you see a massive red candle and you throw a huge lump sum of your capital at it, thinking you're a genius for buying the dip. More often than not in a bear market, that dip just keeps on dipping. There will be many false bottoms. Be patient, wait for confirmation, wait for the market to establish a clear base and show signs of a trend reversal before you start deploying large amounts of capital. Third, have cash on the sidelines. One of the most powerful positions you can have in a bear market is liquidity. Cash gives you options. It allows you to take advantage of those generational buying opportunities when they finally present themselves, when there is blood in the streets. If you are 100% invested, you are forced to simply ride the market down. By holding a portion of your portfolio in cash or a trusted, fully backed stablecoin, you are putting yourself in a position of power, ready to act when the time is right. Fourth, reevaluate your altcoin positions. Bear markets are brutal for altcoins. Many projects that seemed revolutionary during the bull run will go to zero and never recover. This is the time for ruthless portfolio hygiene. Go through every single altcoin you own and ask yourself the hard questions. Does this project have a real use case? Does it have a strong community and active development? Does it have a healthy treasury to survive a multi-year bear market? If the answer is no, you need to seriously consider cutting your losses and consolidating that capital into stronger assets like Bitcoin and Ethereum, or simply moving it to cash. Hope is not a strategy for a failing project. Part 4, finding the diamonds in the rough, planting the seeds for the next bull run. This final part is about shifting your mindset from pure survival to opportunistic growth. Bear markets are where the foundations of the next bull run's biggest winners are laid. While everyone else is panicking and selling, the smart money is quietly researching. This is the time to do your homework. Instead of just chasing hype, really get into the fundamentals. Look for projects that are actually building and shipping products during the downturn. Explore new narratives that are gaining traction, like real-world assets, RWAs, decentralized physical infrastructure, DePIN, or new advances in Layer 2 scaling. The projects that continue to innovate, grow their user base, and manage their finances responsibly during the tough times are the ones that will explode in value when the market eventually turns. The gains you make in the next bull market will be a direct result of the research and patient accumulation you do today. This is the time to become an expert, read the white papers, engage with the communities on Discord, follow the developer activity on GitHub. By following this four-part plan, securing your assets, developing a trend following thesis, executing disciplined strategies, and researching for the future, you transform yourself from a victim of the market into an architect of your own financial destiny. You will not only survive the bear market, but you will emerge from it stronger, wealthier, and more knowledgeable than ever before. So let's bring it all together. The market is in a precarious position. A hawkish Federal Reserve and classic recession indicators have created a perfect macroeconomic storm. This storm is crashing against the shores of a crypto market that is uniquely fragile, built on a mountain of leverage and systemic risk that creates brutal liquidation cascades. We are seeing massive outflows from institutional products, and sentiment has fallen into extreme fear. This is not a time for panic. It is a time for a clear-eyed, disciplined response. Your survival and future success depend on the actions you take right now. First, take control by moving your assets into self-custody with a hardware wallet to protect yourself from exchange failures. Second, adopt a trend-following mindset and detach from emotional biases. Third, deploy defensive and offensive strategies like dollar cost averaging, keeping cash on the sidelines, and cleaning up your altcoin portfolio. And finally, use this time as an opportunity to do the deep research that will uncover the big winners of the next cycle. The coming months will likely be volatile and painful for those who are unprepared. But for those of you who heed this warning and follow this plan, this bear market will not be an ending. It will be a beginning. It could be the single greatest wealth building opportunity of your life. If you found this analysis valuable and you want to stay updated on how this situation develops, make sure you subscribe to the channel and hit that notification bell. I'll be tracking these trends every single day and will be here to guide you through the storm. Stay safe, stay rational, and stay prepared.